Well, welcome back, everyone. For the next session, we're really delighted to welcome Michael Saylor, who's the chairman and CEO of MicroStrategy. Michael has obviously been a flag bearer, or the flag bearer, for the corporate adoption of digital assets globally, and Rashad Salamat, who's well known across Asia as an anchor on Bloomberg. Going to have about 30 minutes and then open up for questions. Let me pass over to Rashad and Michael. Thank you.
Michael, thank you so much for joining us. And everybody, welcome to this OSL Capital. About just some of the basics here as well about Bitcoin as well. So we can move to other cryptos and the technology behind them in a while. But what's the point of it?
Bitcoin is a digital asset that has been engineered to be the ideal long duration, safe haven store of value. So you could think of it as two things. A, it's digital gold, where you can only create 21 million virtual gold coins. And B, it's an open monetary network that stretches globally in reach. So if you do purchase a Bitcoin, it sits on a network and it can be moved anywhere in the world on this open network. And the network is not controlled by a company. Think of it as God designed gold in cyberspace and put it on a decentralized network and decreed there can never be more than 21 million gold coins.
So why did it pique your interest in particular? Why should any layperson be interested in it?
You know, it started out, I guess it's a science experiment, and then it started to spread. And if you'd asked me about Bitcoin in 2013, when it was like a couple of $1 billion on the network, I said, oh, it looks kind of crazy. It's for hackers and gamblers or whatever. I don't think it'll go anywhere. And then if you'd asked me in February, I would have said, I know there's some kind of crypto network they're playing with. I don't quite get it. I don't care. But in March of 2020, it was a very catalytic event. It was, we had the pandemic strike, and you had two things. You had the war on COVID, and then you had this massive fiscal response or monetary response where we took interest rates to zero and we started to stimulate the economy. And what we saw was a K-shaped recovery. We saw all the financial assets immediately inflate in value. And then we saw all the Main Street assets lock down and start to operate suboptimally. So I became interested in March, and by the end of the second quarter, my thought was, I have 500 million in cash. I don't really need the cash to grow the business because we're doing everything virtually. We're Zooming everywhere. We're streaming online. And I'm going to generate a lot more cash. I'm going to generate probably 750 million in cash over the next 5 to 7 years or something. And so that's the good news. And the bad news is the cash is actually being devalued because we've got this massive monetary inflation or expansion of the M2 money supply. And so in essence, the cost of capital went from about 8% to 24% this last 12 months. And I started thinking, how am I going to get 24% return on my cash and my treasury? And the answer was, I can't figure out how to do it. I can't buy bonds. I can't hold the cash. I either have to give the money back to the shareholders, or I have to find something to invest in that's going to appreciate faster than the rate of the S&P 500, which was like 24%, or the rate of the broad money supply expansion, which was like 24%. And so we started on a mad scramble and we discovered Bitcoin. In essence, you would think, should I buy gold? Should I buy silver? Should I buy stock indexes? And of course, by the time we went through everything, we found that Bitcoin was digital gold, and digital gold on a big tech network, Facebook for money. It struck me as being compelling as an investment idea because I like the idea of a big tech network that moves money around. And I thought it was compelling from a fundamental point of view because I like the idea of gold. But if you couldn't make any more gold, and if gold moved at the speed of light and it had no weight and it was 1,000,000 times more programmable than normal gold, that struck me as being a really cool thing. And that's what attracted us to Bitcoin.
Was that it? Was it just that, or was there another thing which just tipped you over the edge? And also, why Bitcoin and not another crypto?
I would say what really tipped us over the edge was the conclusion that it wasn't a one-time monetary stimulus. It wasn't going to be like we lower interest rates to zero and then we bring them back up again at the end of the year. We started to conclude that we're going to be running a multi-trillion-dollar deficit. We're going to buy $1 trillion worth of bonds, and the money supply, which had been expanding at 7% a year, was expanding at 24% a year, and the forecast is for it to expand at like 15% a year for the next 4 years. So once I got that jolt, that V-shaped recovery in Wall Street and the no recovery on Main Street, that caused me to think about the last 10 years of monetary expansion, that kicked me out of my slumber, and I realized that I got to forecast the money supply for the next 8 years. And then once I did a forecast, the forecast started looking like 15% a year. And then once I concluded that, I realized that the conventional treasury strategies, which rely upon short-term government bonds, all have negative real yields, like negative 10% or negative 15% real yields. And it occurred to me that if the world's going to have negative real yields on bonds for the next 4 years, then my choice is either I lose all my capital or I buy something that goes up faster than 15%. And so I would say it was the awareness that it wasn't a one-time thing. It wasn't going to go away. It's going to be with us for 4 years. And I needed to believe for my shareholders, or if I was going to create any shareholder value in a inflating monetary environment.
Well, you certainly did, didn't you? I mean, you went and bought, what, 91,326 of them? Why did you
To
buy
make
so
a
many?
long story short, what we did is we bought 250 million Bitcoin, and we did a $250 million tender offer to buy our stock back. And then the investors decided only to tender 60 million of that stock. So we took the extra 175 million, we bought more Bitcoin, and then we bought another 50 million, and we had about 500 million in Bitcoin. The price of Bitcoin doubled. Then we had $1 billion in Bitcoin. Then we went and borrowed 650 million. We forward financed our cash flows. And when we borrowed that in a convert, we bought Bitcoin with that, and that doubled. And so then we had about 3.5 or 4 billion. So then we went and we borrowed $1 billion at 0% interest, and we bought Bitcoin with that. And then that went up. And so we ended up building into a $5 billion position in Bitcoin from a $500 million position in cash. But we did it because we realized that Bitcoin is appreciating at 200% a year for the last decade. And cash was going to lose about 10 to 15% of its purchasing power a year. And the interest rates were going to be pegged short-term at zero, and we could borrow money cheap. And so the arbitrage opportunity was just too compelling not to do that. And in an environment where the money supply expands at zero, the cost of capital is zero. And then you can hold treasuries and be conservative and focused upon your P&L. But if the money supply expands at 20%, you have to have an asset portfolio that's going to appreciate at that 20%. You need to let the Fed blow wind in your asset sales. And so I think that the big idea here is if cost of capital is low, conventional treasury strategies work. And conventional treasury strategy is be conservative, hold cash, hold treasuries, short-dated treasuries. But when the cost of capital gets high, and if you think it's going to stay high, bonds are broken as a conventional treasury strategy. Now I have to either embrace an equity portfolio, like I got to buy ETFs or an index, or I have to find some property that's going to be scarce enough that people are going to want to keep paying more for it as the money supply expands. And so we became more of a financial, we became an asset-rich company with assets that would appreciate in value over the course of 12 months. Because our view is you can't really be successful in business without assets in a monetary system that's expanding at 15 or 20% a year.
Michael, I want to get a sense. I mean, you recently were having a bit of a set to, that's going a bit too far probably, with Ray Dalio, of course, the Bridgewater Associates founder. He believes in a new paradigm and believes it's going to be characterized by, and I'm just quoting, by shocking tax hikes and prohibitions against capital movements in assets like Bitcoin and gold. And you agree with him in the sense that bonds no longer work as a treasury asset, but you say that Bitcoin is the obvious conclusion to all this. Why?
Yeah, Ray says that cash is trash. He's famous for that statement. And he says that bonds have negative real yields and they don't work anymore, and you're crazy to own a US dollar denominated bond. And then in that paper, he says, well, we're thinking about Bitcoin, but we might be concerned about tax or regulation. We're not sure. But we also think you ought to have a very diversified portfolio of non-dollar denominated, non-debt instruments in emerging Asian countries, including maybe some China debt. That's very complicated. Okay. And so when I look at it, my response is the simple, obvious solution is buy Bitcoin as property. Bitcoin is not going to be a currency. Sure, if people want to move billions of dollars of Bitcoin across borders without KYC and AML, that's going to run into red flags. And I don't think that's going to happen. But I think that in all of the world that respects property rights, if you can buy gold, if you can buy stocks, if you can buy real estate, if you can buy silver and commodities, you can buy Bitcoin. And I don't think the world's got any problem, at least not the Western world, has no problem with people buying Bitcoin to hold as property. And it is the solution to the problem. The problem is, if the fiat currency expands at 15% a year, then not only does the dollar lose 15% of its value every year in purchasing power, but also value stocks that are valued based upon dollar cash flows lose their value. And commercial real estate valued upon rents and dollar cash flows lose their value. And of course, bonds valued in dollar coupons lose their value. So the real problem is an entire diversified portfolio that has any exposure to a currency which is weakening is also going to weaken. And then the theoretical answer is buy a property, buy an asset which is not valued based upon cash flows. And that means precious metals or trophy real estate, some trophy thing that you value, just own it. Art, maybe a Picasso, a Leonardo da Vinci, or Bitcoin. Bitcoin exists only to be a pure monetary store of value, and it is not based upon the cash flows of any product or any service. And it is the apex asset because no government can print any more of it, and no CEO can print any more of it. Yeah.
I just want to jump in. Okay, Michael, ultimately, it is Bitcoin is also dollar denominated. That's one thing. And if we see further currency debasement, how does that play out with Bitcoin? Should Bitcoin be priced in another currency? And just want to go on a little bit from that. And if we get further dollar debasement, is that one of the things which has been turbocharging Bitcoin itself now over the last 12 months?
Yeah, well, the way to think about Bitcoin is there's never going to be more than 21 million. So if you double the amount of dollars, it's got to be worth twice as much. And if you increase the number of dollars by a factor of 10, then you've got a lot more dollars chasing after the same exact Bitcoins. And everybody pretty much expects Bitcoin's going to have 21 million cap 150 years from now. You can't say that about commodities, credit, bonds, stocks, real estate. So in countries where the currency is collapsing faster, like Argentina, Bitcoin goes up even faster, right? If you have a very hard currency, Bitcoin goes up slower. It's basically just a way to acquire property in cyberspace in a different dimension than the current country. And the reason that it's the apex property is because if I bought ranches in California, I got California property tax. If I bought property in Switzerland, I'm subject to Swiss law, Swiss regulation. If I bought any other kind of stock, I'm subject to either the execution risk of the company or the competition of the company. So what is the risk in Bitcoin? Well, it's a monetary network. So the risk is another monetary network in cyberspace. And the thing that's so appealing to Bitcoin is it's the first $1 trillion digital monetary network. The next best one is 100 times smaller. So it's got network dominance. It rose to $1 trillion in 12 years. It's got massive momentum. And you can imagine the inertia of $1 trillion of money sitting on a network. Think about how hard people will fight to defend the $1 trillion they've deposited into this network. I say Bitcoin is a bank in cyberspace. And you can really think of it as the most successful bank in cyberspace. And it's arising to offer a very simple solution. It's a store of value solution at a time when everybody on Earth, all 7.8 billion people, need a store of value. Every investor with the $400 trillion worth of fiat derivatives needs a store of value. Every institution needs a store of value. And 100 million companies, private, and 10,000 public companies need a treasury strategy, which is a store of value. So it's simply a technical solution to a problem that became front and center, a big issue for everybody starting in March of 2020.
So, Michael, that brings me nicely to. So it's not going to be going back and dialing back. There's a lot to unpack here. It's not going to be a currency in your view. It's going to be merely a store of value. But is it a store of value which is being bought on a speculative basis? That's the thing.
Yeah, I think that in the early years, if you look at Bitcoin's development from 2010 to 2020, it was speculative. And by 2017 and 2018, in that first blow off top, when it went to 19,000 and it crashed, it was a lot of leverage speculators, and they were basically using Bitcoin to leverage to get to ICOs, to trade other crypto assets. And there was a small minority of hodlers that believed it was a store of value asset class. What happened in March of 2020 is that this became digital gold to anybody who's a macro investor who's concerned with the great monetary inflation, as Paul Tudor Jones called it. And when Paul Tudor Jones anointed it as the next digital gold, and Stanley Druckenmiller grabbed it, and Skybridge and Guggenheim, and everybody else started thinking about it, the narrative transitioned to store of value. The institutional investors, they came in with deep pockets. Their duration stretched out. The leverage decreased. And you had companies like mine that are saying, I just want to hold it forever, for 100 years. And the other thing that happened is, when Bitcoin is a monetary fire burning in cyberspace, how do you feed a fire, a monetary fire? You feed it money. And so when this fire burned into the public market, when it hit MicroStrategy, what happens? Well, a guy like me goes, okay, I think I'll buy about 175 million of it. And then I think my company will buy 250 million of it. We'll buy another 250 million. We'll just borrow 650 million at 75 basis points and borrow some more. We'll borrow $1 billion at 0% interest and borrow some more. So when the fire was burning through individual speculators, it was growing at 200% a year for a decade. When it hit the public markets after March, it started growing at 400% a year. It accelerated. It's like that fire goes through the warehouse and it hits the tanks of gasoline, and we pour gasoline on the fire. So that's what's happening right now. It's rotating, and if I'm a public company, I don't ever have to sell it. In fact, like MicroStrategy doesn't sell, I can borrow money or issue equity forever. Now, all the Bitcoin miners have come public. Riot, Marathon, Hut 8. There's another SPAC, Cypher's coming public. So imagine what happens if a Bitcoin miner is private. They mine Bitcoin and they sell it. When the Bitcoin miner becomes flow, goes to infinity, and then it goes negative, because now all the miners are slurping the Bitcoin out of the system. Because why would you sell something yielding 200% interest and invest in something with minus 15% interest? So cheap capital.
Michael, I just want to get a sense. Okay, it's the fire burning. Then naturally, my question is going to be, what's going to be the water that goes on it? Would it be the removal of anonymity? Of course, there's a lot of guff said about that, because it can be tracked who owns it, etc., through the blockchain ledger. And also, what about cloning here? That's another bit of water that could be put onto this. What about scalability? You can do 7 times a second transactions with it, that sort of thing. Are these all obstacles in the path of Bitcoin?
Okay, well, when you think about it as digital gold, you say, well, it looks perfect. So will it be banned? Will it be copied? Will it be hacked? And so the only way you know it's not going to be hacked is you watch it for 12 years. That's why it's a much safer idea when it's $1 trillion and 12 years old and it hasn't been hacked, and the network has got tens of billions of dollars invested in it to secure it. So no one's ever hacked Bitcoin. So that was the one big concern. The second is, will it be banned? Well, you couldn't know in 2013 when the IRS made it property in 2014, and when the SEC called it property, and when the OCC said that banks can custody it. All of a sudden you got comfortable. It's not a currency, but it is a property. The tax treatment says I need to buy it and hold it for a decade. If it was currency, I could buy it for a week and I could transfer it a month later with no tax. That's obviously not going to happen. So what you've got is currency bifurcating into medium of exchange. That's dollars and euros and yen. Store of value. That's Bitcoin, gold, or stocks. So that was the second issue. It got normalized as property. The pushback on it, the concern, is it scalable enough? I think my point with that is that if you've got it if you're trying to use it to buy a cup of coffee and replace the dollar, no, it's not scalable enough, but that's not going to happen because the tax treatment is hostile to it. But if what you want to do is buy $1 billion of it and hold it for a decade, you only need one transaction a decade or maybe 10. And so you should think of it as a first level settlement network for huge blocks of digital gold. And the way that it grows from here is other companies plug into it, like Square and PayPal. They plug into it and their payment networks. And then MasterCard and Visa plug into it. And then JP Morgan and Morgan Stanley and Citigroup, they will plug into it. And you will have the Fidelities, the insurance companies, the fund companies, the banks, and the mobile app companies. They'll provide the scalability, and it will be legitimized as a store of value. And that's how people will get over all their concerns about either scalability or regulation.
So, Mike, ultimately then, what you're suggesting, as many have, that a country like, let's say, China, which has its population has the biggest number of Bitcoin, they couldn't shut it down even if they tried.
Yeah, I think that if you...
India's trying to do something along those lines at the moment. They're considering this.
There's about 120 million to 140 million people with Bitcoin right now. And I would say it's past the event horizon. We'll have 1 billion people having Bitcoin within 5 years. We'll have 200 million or more by the end of this year. It's going that fast. I think they're adding like 6 million a month or something like that, maybe 8 million a month. So you can't stop it, because anybody with a mobile phone anywhere in the world with a VPN could go and get it, and you could move it peer to peer. So you can make it a bit more challenging. And in India and in China, they'll make it more challenging to buy it and scale. But it's in India and in China, for example, you can't actually access Google or Facebook, but that doesn't make those stocks bad investments. Ultimately, Western Europe and the United States is where the 80% of the money is, or 90% of the money. And between that and moving through major finance centers, et cetera, Singapore and the like, I think you're going to see that the monetary energy from those is more than enough to drive it through the market cap of gold, which would make it 10x bigger. And it should go to between 10 trillion and 100 trillion. And at that point, who knows what happens? I can't be sure.
Michael,
everybody needs that much.
We've only got 2 or 3 minutes left, so just very, very briefly, just answering these questions. You think it's going to be $100 trillion market?
I do. I think it's a no-brainer. It flips gold, because that's 10 trillion, and so it's 1 trillion now. So it'll run there pretty fast, and then I think it'll kind of start to grow progressively, not at 200% a year, but 100%, and then 50%, and then 30%, and then 20%. And ultimately, the elephant in the room here is there's $100 trillion of treasury assets that are like negative yielding debt or low yielding debt. That $100 trillion of assets and indexes, that all has a negative real yield. And so it doesn't work for insurance companies and for long-term investors and for corporations. They're going to need to find something that's got long duration with a positive yield in every monetary environment. And Bitcoin is the perfect engineered treasury asset. If you were coming out of central casting saying, Design me an asset that an insurance company can hold to fund insurance policies for 30 years. Or design me an asset for Apple Computer to hold instead of cash. I mean, Bitcoin is the ideal asset, and there's nothing else that's close.
Mike, a couple more left. Just want to ask you, do digital currencies such as the ones that Scandinavia, parts of the EU and China considering, does that impact, or does this have any kind of impact on Bitcoin and other cryptos?
No, once you understand that Bitcoin is an asset and that dollars and euros are a currency, what you see is that digital currencies compete with other currencies. So the digital currency is more threatening to MasterCard and Visa and currency networks and payment networks. And the digital yuan is threatening to the yen and to the dollar and the euro. And they're going to work it out there. The digital asset, Bitcoin, is threatening most of all right now to gold and then to other treasury assets or stores of value. I did a survey on Twitter and I asked, and I got 60,000 responses. I said, where did you get the capital you used to allocate to Bitcoin? It was 49% stocks. It was 21% gold. It was 19% property. It was 10% bonds. So money is flowing from those assets into Bitcoin, and I think that'll continue.
Michael, final question here, and this is really about the many in the audience which are where you were this time last year. There's some which are perhaps even beyond where you are right now in terms of their belief in cryptos and Bitcoin. What's your message to the people who are where you were this time last year? And the message being, of course, what should they do next? Have they missed the boat, perhaps?
Okay, well, so first, you haven't missed the boat, right? People like me, I bought it at 10,000. I bought it at 57,000. I'm buying it. I'll be buying it 100,000, 200,000 because I don't have a better idea. You haven't missed the boat. The number one thing you got to do as an investor, in my opinion, is you have to estimate the rate of monetary inflation each year for the next 8 years. And you have to fill in a spreadsheet with your estimate. Is it 15% a year? Is it 20? Is it 5? Is it 7? That drives every other decision you make. Once you come up with that, my opinion is 15 to 17% on average, but you have to come up with your own opinion because that's the input that drives all other asset values and drives all portfolio theory. After you've done that, my suggestion is you go to hope.com. That's a website where we posted all sorts of Bitcoin material, and there's resources and books and articles and videos. And study this, and don't spend money until you understand it. It takes about 10 hours to really get it, and you'll be an expert in 20, and you could get the basics of it in 3 or 4. But go study it, and then decide for yourself what you think after you study it. The information is free. Most people don't do the work. And so if you don't do the work, you dismiss it out of hand because it's a paradigm shift. If you do the work, you'll say, this is monetary electricity. And the first time in 5,000 years, the human race figured out how to put encrypted money on a digital network and move it around, at the speed of light and store it for 100 years with no power loss. And if you believe that, your decision making will be simple. And if you don't believe that, you should study it enough until you either agree or you disagree, and then your decision will still be simple.
Michael, thank you so much. We're going to just send it back to our illustrious host, and I've got to go off and pay some bills. But thank you very much indeed, and I think we're going to be taking some questions from the audience now, are we not, Matt?
Yeah, thanks for having me. Yeah.
Cheers, thank you, Rashad. Really fascinating, and it's great to hear. Let me, so Michael, let me pick up some of the questions that we see coming in from the floor. One which I think we've probably addressed, but to bring that out, the question around regulation, US dollar hegemony. How do you view that and it as a threat, and protecting that as a threat to to Bitcoin?
Yeah, I think that ultimately, first of all, it's pretty well regulated now in every institution that you've read about. And there's probably 1,000 big ones that bought Bitcoin in the last 12 months. They're all buying this on regulated exchanges subject to anti-money laundering, know your customer rules. And so 2 or 3 years ago, I don't know I could say that. I think that the maturation of the on-ramps this year is a big part of the story. Now, there's a little bit more ambiguity in the United States around the last element of parity with stocks and bonds and other assets. And I think that if they clarify that last bit of regulation, it'll be bullish for the asset class, because all the institutions and the insurance companies and the investors, they all want very clear AML KYC regs, and they're comfortable with it, and they're just buying this instead of other assets. So no one has suggested any kind of regulation that isn't, in essence, just establishing parity on AML KYC as an asset class. And there's a little bit of discussion of clarification of what digital assets are security versus property, but that has an impact primarily on the non-Bitcoin crypto assets, Ripple and the like. It doesn't really affect Bitcoin. Bitcoin is kind of the oldest, most decentralized, least ambiguous, clearest form of digital property in the world. I think you will see regulatory FUD about what are the Indians going to do, or I heard something's going on in Nigeria. Look, in countries that have weak property rights, and more authoritarian regimes, and the Indians they just kind of outlawed money, and you had 48 hours to give up all your cash 3 years ago, and you had to turn in all your bills, and you had to get some new bills. Every 3 to 4 years, the Indians do something that's kind of quirky with regard to their currency. I don't think that affects the way people view Google, Facebook, Amazon, or Apple. So the key to keep in mind is this is a digital monetary network, and it provides the ability to store digital gold on a big tech network. And it's going to work really well in Western Europe and the United States and Singapore and Australia, and every place that's comfortable with digital networks. They're going to be fine. And there's going to be FUD else. And it'll go underground in Nigeria or Venezuela or China, and it'll be there because you can't get rid of it. It's encrypted, and anywhere you've got a computer or a smartphone and a firewall, you can hold this. In fact, it's so hard to get rid of. I can put the seed phrase in my head, and you can rip the phone out of my hands, turn off the internet, take away my computers. You still can't get the stuff out of my head. So it's the ultimate sovereign digital property ever invented in the history of the world. It won't go away, but it will flow more clearly as property in the Western world.
Okay, so taking I guess a slightly different direction then, with respect to your treasury strategy, is it specifically aligned to Bitcoin investment? Have you actually made the decision not to look at other digital assets, not to look at sort of DeFi and other parts of the market? Are you constrained at the moment, either sort of specifically or at a mandate level to Bitcoin?
Look, Bitcoin is the crypto asset network. If you're designing a decentralized network to store value for the next 1,000 years, that's Bitcoin. The protocol is optimized for digital gold store of value. It's slow, it's secure, it's like impenetrable. It's granite in cyberspace to build a city on. The other cryptos, they're all trying to do different things like DeFi and privacy and provenance and be optimized for, non-fungible tokens and art. And they're all interesting, but I would call them all venture capital investment. They're all ventures. They're adventures. They're a lot more risky, a lot more complicated. If you have a venture fund and you want to invest in crypto ventures, you do that. If you actually have widows and orphans treasury, you're a stodgy insurance company, and you simply don't want to lose the money, you're not trying to invent something new. You don't want to juggle razor blades. What you want is just to have $1 million and put it on the network and not have everybody take it and not lose it. And so no bells and whistles. So Bitcoin is a treasury reserve network. Everything else is pursuing a different total addressable market. By the way, in my opinion, the addressable market for a treasury reserve asset is 100 trillion. The total addressable market for everything else is like, I mean, a trillion is a lot of money, right? A billion's a lot of money. A trillion, there's only 5 companies that are a trillion in market cap. So I don't really think you need to look that far to find the high opportunity dominant network. I want something 100 times bigger than the next best thing that's fit for purpose.
Okay. So again, let's maybe taking now down into the weeds a little bit, because I think as some of the corporates that are listening today, one of the things, and you alluded, I think, very briefly to this, was to accounting policy and how Bitcoin is held on the balance sheet. How did you deal with that sort of accounting treatment at the moment and the impact on sort of the valuation on the balance sheet and the obvious then move through to share price? I mean, that's got to be a key consideration for a treasurer, right?
Yeah. So if you buy Bitcoin as a naked asset, if you want to own the actual Bitcoin property, right now the accounting for it under GAAP is as an indefinite intangible. So it's actually not a great accounting treatment. It's not terribly transparent, and you can mark it down, but you can't mark it up, right? So if GAAP accounting is important to you, then the other approach is you buy it as a fund. You basically buy a fund whose primary strategy is to buy Bitcoin. So if I owned a fund, then I would have fund accounting, and it's likely in that case that you get fair value accounting. Right? They both have pros and cons. If you go with the pure Bitcoin, you have more optionality, but you're gonna have to rely upon pro forma reporting in order to make that clear to your investors. And I would say, legitimately, the only intelligent concern that I can articulate is if you're a CFO with a beautiful P&L and a beautiful balance sheet, and you buy the underlying Bitcoin, it's going to make it ugly, or it's going to make it muddy. So that's a legitimate concern. And so in that case, I would probably say you want to look at it as a fund and think about buying some as a fund. Okay.
All right. That's great insight. Thank you. We're sort of ticking down probably towards last question or two. What worries you then? You're obviously heavily invested, heavily convicted. What worries you around the investment paradigm, the market? I mean,
I think a rational, honest person has to accept that there's always black swans. There's unknown unknowns. It's 12 years old. There's a lot fewer in 12 years, but you have to accept the fact of a black swan. So I can't discount that. It's a good asset. It's such a good asset that what you see is billions and tens of billions and hundreds of billions of dollars of assets flowing out of other assets. So I think that you're going to have banks that don't embrace it. They'll be threatened by it, and it's threatening to gold, it's threatening to silver, it's threatening to bonds, and it's upending the power structure in fintech. Like Square and PayPal, they're getting millions and millions of new users because they have it, and that's threatening to Facebook and Google. No. So I think that it's such a good thing that you're going to get pushback, and the pushback will be either FUD, environmental FUD, oh, it's not great for the environment, or you'll get regulatory FUD. I heard that someone's going to tax it, or it's possible theoretically that someone might theoretically do something, because what do you say when it's, but if people didn't have that FUD, I feel like it would all be trading at $1 million a coin right now. I mean, in theory, why in the world wouldn't you have replaced all of gold, all of silver, and all negative yielding sovereign debt with this stuff? And that takes you up to 30 trillion right there. So I think that the FUD will come, and I think that there'll be a lot of entities that'll have a vested interest in mudding those waters, just because something that's growing 200% a year that accelerated to grow 400% a year is disruptive. Matt, I would say, and I don't think this is hyperbolic, I think that Bitcoin is the single most disruptive technology in the world right now. It's a monetary fire, and if you want an indicia of that, it got to $1 trillion in 12 years. Facebook still didn't get to $1 trillion. And it took Google 22 years, and it took Apple 42 years. Nothing in the history of technology ever got to $1 trillion in 12 years without a marketing budget.
Yeah.
So it is disruptive, and there's going to be sparks that will happen. Just like, you go fast, you break the speed of sound, you're going to get a shock wave.
Michael, terrific. Look, we're right up out of time. Thank you very much for joining us. It is insightful and truly great to hear of your journey. Thank you for sharing with with our guests today. Much appreciated.
Thanks for having me. All the best to everybody.
Cheers.
Thank you.
Thanks, Michael.